Are you surprised at how high your income taxes have become? Remember this from an old Morgan Stanley ad. You must pay taxes, but there's no law that says you have to leave a tip. Hello, this is Blaine Carr with Petersen, Hastings. Did you used to end up with more tax deductions when you itemized? This is the case for millions of Americans ever since the Tax Cuts and Jobs Act went into effect in 2018. This act removed dependency exemptions and roughly doubled the standard deduction for individuals. While many taxpayers are better off under this system, some still might be able to increase their tax deductions and lower their tax bills. First, let's break down itemized deductions. When you prepare your income tax return, you add up your deductions for medical, state and local taxes, mortgage interest, gifts to charity, etc. If the total of all of these deductions exceeds the standard deduction, you are entitled to itemize your deductions using Schedule A. If your deductions do not exceed the standard deduction, about $25,000 for joint filers in 2021, then you get to use the higher standard deduction instead. The opportunity comes for those taxpayers who have a lot of allowable deductions yet still do not exceed the threshold of the standard deduction. This could be a one-time situation, maybe it's a regular occurrence. I'm going to explain the latter, and then you can apply it to the one-time situation accordingly. With bunching, you shift as many of your deductions as you can from multiple tax years into a single tax year. You itemize deductions for the year you bunch them, and then you take the standard deduction for the other years. You can bunch every other year, every third year, or some other frequency. Let's look at an example. Here, the taxpayer is filing a joint tax return. We'll keep it simple and use the same deductions for years 1 and 2. Deductions for taxes, interest, and charity total $22,000 each year. Under normal circumstances, this taxpayer would use the $25,000 standard deduction each year for a total of $50,000. Scenario 2. After gaining great insight from this video, the taxpayer decides to prepay his year 2 charitable contributions at the end of year 1. Everything else is the same. This taxpayer will be able to itemize $30,000 of deductions for the first year and then take the standard deduction for the second year, totaling $55,000 in deductions. This extra $5,000 of deductions would yield a $1,100 tax savings over the 2-year period, assuming a 22% tax bracket. And I've seen other situations yield a lot more in tax savings. Don't assume you are able to bunch all your deductions. Your mortgage needs to be paid according to the contract, but you can make an early or extra payment at the end of the year to capture the accrued interest as a deduction. Many municipalities will not allow you to prepay your property taxes. Gifts to charity are the easiest to bunch, yet you should consider the effect this will have on the cash flow of the charity. Let's quickly review this concept. Evaluate your itemized deductions relative to the standard deduction provided for your filing status. Determine which deductions over multiple tax years you can bunch into a single tax year. Be sure to save up the money in an account so that you can pay these deductions. You can even pay early and late in the same tax year to make it easier on a charity. Be sure to save your receipts so that you remember to itemize these deductions when you file your return. Thanks a bunch for joining me today. You should check with your tax advisor before you implement any of the strategies covered in this video. Please share this video with your friends and family. Next time, we will take a deeper dive into charitable giving.